We all think of filing our GSTR1 return as, well, just another chore, right? A box to tick. But what if I told you that single form holds the power to make or break your most important business relationships? Yeah, seriously. So today, we're going to dive into the 5 biggest, most dangerous mistakes you can make when filing your GSTR1, and of course, how you can steer clear of them.
It might sound a little over the top, but trust me, the answer is a big, resounding yes. We're talking about a single wrong number, a misplaced decimal point, even just forgetting something small, and it can kick off this domino effect with some pretty serious financial pain. Let's break down exactly how that can happen.
So here's the first thing you really need to get. Your GSTR1, it's not just a form you fill out. Think of it more like the engine of the entire GST system. I mean, it's the heart of the whole thing. Every single sale you report on it, that becomes the official, undisputed record. It's the very first link in a chain that connects you directly to your customers' tax credits.
And that brings us to what I like to call the domino effect. See, the numbers you file don't just sit in your account. Nope, they travel through the whole GST network, and they directly hit the books of everyone you work with. Let's really look at how this plays out. It's actually a really simple, automatic 3-step dance. Step 1, you report a sales invoice in your GSTR1. Easy enough. Step 2, that exact same data without any changes just pops up in your customer's GSTR2B. Now that's their official list of tax credits they can claim. And finally, Step 3, your customer looks at their GSTR2B and claims that input tax credit in their GSTR3B. See? It's a straight automated line from you to them.
So what does this all mean? It's actually a huge deal. Your accuracy, it's not just your problem anymore, it's your customer's problem. A mistake on your end can literally block their cash flow and legally stop them from getting a tax credit they are totally entitled to. All of a sudden, this boring filing task becomes absolutely critical for keeping your business relationships healthy.
All right, let's dive into the first big, high-risk error. And honestly, this one is the most common one we see: failures in data integrity. I call it the mismatch catalyst, because one tiny little clerical error can set off this huge chain reaction of problems throughout the system.
And you know what's crazy? It's how boring these mistakes are. We're talking about a simple typo in a customer's GSTIN, getting an invoice value off by a little bit, clicking the wrong tax rate from a drop-down menu, or hey, just forgetting to upload an invoice altogether. These are everyday slip-ups, right? But in the world of GST, their consequences are, well, they're anything but boring.
This really shows you how out of whack the consequences can be. Just picture this. You type one single digit wrong in your customer's GSTIN. Just one. What's the result? The whole system goes, nope, can't match this, and bam, your customer is automatically and legally blocked from claiming their tax credit. Your tiny little typo just turned into a massive financial headache for them.
And get this, what if your customer decides to claim that credit anyway? Maybe they think, we'll sort it out later. Well, the penalty for that can be up to 100% of the tax amount, plus interest. That's a huge gamble to take, and it all started with that one little data entry mistake back at the beginning.
Okay, on to error number 2. This one is all about cash flow. And trust me, getting your tax classification wrong can jam up your working capital in a really painful way. So here's a super common scenario. You make a sale from one state to another, which is an interstate sale, so you're supposed to charge IGST. But oops, by mistake, you classified it as a local sale and charged CGST and SGST instead. Hey, you still paid the tax, so it's all good, right?
Now, wrong. The process to fix this is, well, it's a nightmare. First, you have to pay the correct tax, the IGST, right away, straight out of your bank account. Then you have to pay 18% annual interest because that payment was technically late. After that, you can apply for a refund of the wrong tax you paid, and then you just wait and wait. Your money is completely stuck until that refund comes through, and that can take months. So yeah, one simple mistake, and your cash is literally frozen.
All right, next up, we've got a 2-for-1. Errors 3 and 4 are what I call hidden traps. They're sneaky because they usually happen when you don't do something or because of a tiny paperwork mistake. But don't be fooled, they can cost you cold, hard cash.
Okay, picture this. You had a quiet month. No sales, no invoices, nothing. So common sense would tell you, hey, I can probably just skip filing my GSTR1 this month, right? I mean, what's there to even report?
Wrong. That is completely 100% wrong. A nil return is still a return. You are legally required to file it, period. Not filing it is a straight-up compliance failure.
And of course, it comes with an automatic penalty. For a late NIL return, you're looking at a late fee of 20 rupees a day. Now, that might not sound like a lot, but it adds up fast, and it's a sign of a much bigger issue.
But here's the real kicker. Here's the catch that makes this trap so nasty. You have to pay those late fees in cash. You can't just use your available input tax credit to cover it. That means it's a direct hit to your bank account, all because you didn't file a return that had nothing on it to begin with.
And here's another quick one. This one's for all the exporters out there. Your annual letter of undertaking, the LUT? If you file that thing even one day late, you lose your right to export without paying tax. Suddenly, you're forced to pay IGST on everything you ship out, and then you have to go through the whole refund process. Once again, a simple piece of paper blocking your cash flow.
Okay, we've arrived at our final error, and I've saved the most unforgiving one for last. This is all about a deadline, a hard deadline, the point of no return when it comes to fixing your mistakes.
So listen up, because this is critical. For any mistake you make in a financial year, you have until November 30th of the following financial year to fix it. So from mistake made in the 2023-24 year, your final drop-dead date is November 30th, 2024. After that, it's over.
And I'm not kidding when I say this isn't a soft deadline. Once that day passes, the GST portal literally locks you out. You cannot make any more changes for that period. Any mistake that's still there becomes a permanent financial loss. Your customers deny that tax credit forever. And the damage that does to your business relationship, it could be permanent too. Okay, so we've talked a lot about the problems, which can be a bit scary, but let's switch gears and talk about solutions. How do you actually protect your business from all this? The good news is, it's not about being perfect. Nobody's perfect. It's about having a smart plan to handle these risks.
Here's a simple 3-step defense strategy. First, automate. Look, manual checks are just asking for trouble. Use good software to constantly match up your data and catch those errors before they become big problems. Second, verify. Just implement a simple 2-person check, a second pair of eyes on the critical stuff like GSTNs and invoice amounts before you file. And third, communicate. Be proactive. Don't sit on a problem. If you spot a discrepancy, pick up the phone or shoot an email to your customer right away and get it fixed.
Which brings us to one last, really important question to ask yourself. After everything we've talked about, after seeing how your GSTR1 accuracy directly hits your cash flow and your customer relationships, is your compliance process a business asset that actually builds trust? Or is it a ticking time bomb, a financial liability just waiting to explode? Really think about that. The choice is up to you.